asking me, right, what is the best form of investments? And so today we're going to look at stocks, bonds, crypto, and even derivatives, right? And then we are going to explore the pros and cons. And right at the end, I'm going to teach you how to choose which one is the best investment. But before we begin, right, I just want to make sure everybody is on the same page, because I remember when I first started investing, there was a sea of information out there. And basically, right, when I read stuff or when I watch certain videos, right, there were so many terms that I found quite confusing, and some of the terms were used interchangeably, which I just want to define the difference between investing and trading. Investing is something that takes a longer time frame, usually 5 to 10 years or more. And basically, we are interested in fundamental analysis, which is basically how the company performs. Whereas for trading, it really depends what kind of trading you do. If you do things like day trading, then you're talking about seconds, minutes, or hours. Or if you do swing trading, it can be days, weeks, or even months. And what you're doing is technical analysis, where you basically look at chart patterns and certain indicators before you make your move. So what we're going to do now is to look at the different investment tools available to us. And what I've done is basically I've broken them down into 4 main groups. Okay, I've broken them down into stocks, bonds, cryptocurrency, and derivatives. And what we're going to do is we're going to assess them on 4 factors as well. We're going to look at them based on their volatility, the effort it takes to make the investment successful, the time frame that you need, and of course the potential return. How we're going to do this, right, is we're going to score them on a scale of 1 to 10, where 10 being the most volatile, highest amount of effort to make the investment successful, longest time frame, but also highest possible returns. And at the same time, if something scores 1, it means it is the least volatile, least amount of effort, shortest time frame, and lowest potential returns. So in our first bucket, we are basically talking about equities or stocks. So there are 3 ways to buy them. You can either buy it through index funds, through mutual funds or unit trusts, and then you can actually buy the individual stocks, and each of these differs slightly. Now, to begin, right, we're actually going to focus on index funds for the very simple reason, when we actually invest, right, we're actually hoping to beat the market. And what does beat the market means? It means to actually do better than the index funds. So basically, we're going to look at an index fund, and everything else here on forth will basically be compared against the index funds. So for index funds, right, in terms of volatility, if you ask me, I would say this is a 5 out of 10, because this is the benchmark. Everything will be measured against it. Things that are more volatile than indexes will be higher than 5. Less volatile will be lower than 5 lah. But in terms of effort, I would say this is a 3 out of 10. Some effort is still needed, because basically index funds there are 2 types. There are the kind that basically represents the whole economy of a country or sectors of the economy. So you basically need to understand whether or not the country's economy will continue to do well, or whether that sector in the economy will continue to do well. So a little bit of effort is still needed, but generally, right, as long as you have a long enough time frame, more than 10 years, preferably actually over 20 years, right, you can definitely make money through index funds. But basically, because index funds are basically representing the broader market, right, so in terms of returns, it's also neutral returns. Now, I'm not saying that index funds return that giving you 8% every year are bad returns, but basically because this is what usually people are measured against, so 8% in the sense is like the passing mark, like 5 out of 10. Lower than 8%, maybe not so good returns. Higher than 8% is usually what we are aiming for. And so we come to mutual funds and stocks. So for mutual funds and stocks, right, they share a lot of similar properties with some slight differences lah. Now, in terms of volatility, of course, mutual funds slightly less volatile, because they are still a group of stocks picked by a fund manager, usually 30, 50, or even 100 stocks, whereas buying an individual company, your whole return is basically dependent on that one company. So definitely that one is a bit more volatile. So for mutual fund, it will be a 6 out of 10 for volatility, and then for individual stocks, I would say a 7 out of 10. Now, when it comes to effort, right, actually in terms of mutual fund, I still think some effort is needed. It's not just you put your money there and you forget about it and you just trust the fund manager, because you actually need to know whether or not you agree with what the fund manager is doing with your money. So you need to do some initial research. So that's why I'll put this maybe a 5 out of 10. However, once you have actually invested your money, you are safe, you feel safe with the companies, right, you can actually leave the fund manager, right, to continue following up with the news and make changes as necessary. However, for stock investing, right, where you are picking your own stocks, I would actually say the effort takes 9 out of 10, for the very simple reason, not only have you got to do the initial research, you actually got to follow the news of the company and to see how they perform every single quarter. So in terms of time frame, right, I would say mutual funds and stocks are both about the same, both about 8 upon 10, for the very simple reason, right, you still need a long time horizon for your investment thesis to play out. However, in both cases, right, when I buy mutual funds and stocks, what I'm trying to do is I'm trying to beat the market. So there actually needs to be slightly more active management on my part, where I buy and sell certain positions in order to beat the market. That's why I say 8 upon 10 compared to 10 upon 10 for index funds. Now, finally, in terms of returns, right, now for stocks, I think very straightforward, 9 upon 10. However, for mutual funds, this is the only category where I actually gave a range of answers. I would say 4 to 6 stars here for the very simple reason a lot of mutual funds actually lose to the index, but if you pick the right ones, you are able to beat the market as well. So 6 upon 10. This second bucket, right, we're actually talking about bonds and treasuries. And so what I've done is actually split it into two components, into low yield bonds and high yield bonds. Now, for low yield bonds, right, they're what we call investment grade bonds. So in terms of volatility, these are not very volatile. So I would say this is a 2 out of 10. Now, in terms of effort needed, I would say this is another 2 out of 10. Because for instance, if you're buying like the Singapore savings bond, right, all you need to ask yourself is, will Singapore still be around? Will we still be prosperous? If your answer is yes, chances are the government will still be around to pay you the interest and return you your capital. So in terms of timing, right, for low yield bonds, I actually say this is a 2 out of 10 because I don't use these kind of instruments for long-term investment. I actually use it for a short-term store of cash. And finally, in terms of returns, as the name suggests, low yield bonds, the returns is not very high. So, naturally speaking, this is also a 2 out of 10, usually because they are lower than inflation. That's the first thing. And the second thing is because they're very interest rate sensitive. Now we talk about the second type of bonds, right? High yield bonds. Now, high yield bonds in terms of volatility, I would say this is 7 out of 10. Very similar to buying individual stocks. However, in terms of effort, I would say this is a 10 out of 10 because it's actually not very easy to understand the debt structure of a company. What do I mean? Now, when a company needs to borrow money, they don't usually just borrow from one person, they borrow from many lenders. And now, each of these lenders actually lend to the company at different rates along different time frames, and they actually have a hierarchy of who gets paid first. So it's actually not very easy to understand the debt structure of the company. That's why I say this is a 10 out of 10. Now, in terms of time frame and returns, right, I would say that both of that would be about a 7 out of 10. For the very simple reason, for many of these people that do investing in this kind of bonds, right, they're actually looking for highly distressed companies that are actually pretty close to bankruptcy, and they actually do a very deep research into this, right, to understand that actually it's not true, the company is not going to go bankrupt, but for that to happen, right, they actually need time for the basically company to recover and for their thesis to play out. And at the same time, in terms of returns, right, they can actually get pretty decent returns because you can get a pretty good yield on your money, and at the same time, the bond price will appreciate. In the third bucket, we're talking about cryptocurrency. I know there are the bigger coins like Bitcoin, Ethereum, and also the smaller projects, but here we're looking at the asset class in totality. So in terms of volatility, right, if you ask me, I would score this a 10 out of 10, and I think none of us would disagree, right, that basically the price movements of cryptocurrency is much more drastic than stocks and index funds. In terms of effort, to me, this is also a 10 out of 10 because I think the learning curve when you want to enter the world of crypto is actually quite steep. There's a lot of terminologies that you got to understand. Not only that, you got to understand the philosophy and the technology behind it. And then for the smaller projects, right, you really need to really dig deep to understand what they're doing and to understand the value proposition of them. In terms of timing here, right, I actually give it a 4 out of 10 for the very simple reason. I think there are certain coins that people will argue that these are longer term hold, things like Bitcoin and Ethereum, but also smaller projects where people make shorter term trades, and you have to understand the Bitcoin cycle to basically make these trades successfully. So that's why I give it a 4 out of 10, basically an average. And so in terms of returns, right, I think we can all agree that this is also a 10 out of 10. For the bigger coins, you can make many multiples of what the stock price does. For the smaller coins, you can actually become an overnight millionaire, but at the same time, you can also be an overnight bankrupt. Finally, we come to our fourth group, right, which is financial derivatives, things like options and futures. So in terms of volatility, right, I actually scored this a 10 out of 10 because for the very simple reason, the price movement of options and futures are far more drastic than the underlying stock price itself. Now, in terms of effort, I actually scored this a 10 out of 10 as well because just now when we talk about stocks, I actually scored researching a stock, studying a stock 9 out of 10. So for derivatives, right, you not only have to choose the correct stock, you actually have to know when to buy and when to sell to maximize your profit. And so this extra effort that it takes to basically time your buy and sell is why I give it 10 out of 10. Then we come and talk about timing. Now, timing here I was quite undecided. I kept moving between 2, 3, and 4, but eventually decided on 2 out of 10. I realized for most people, right, when they use derivatives, it's a very short-term thing and they basically keep it to within 2 years. And finally, right, in terms of returns, it's definitely a 10 out of 10 because it can make you multiples of what the stock price actually moves. So when people ask me, right, which is actually the best investment tool, I think the question can actually be better reframed into 2 parts. The first thing they should ask is, how does each investment tool work? And the second thing is, when should I use each investment tool to give me the best returns? But before we even get there, if you don't ask yourself these 3 questions before you start investing, you are bound to lose money, and I talk more about them in this video over here.